AVTECH AB, Clouds are clearing. AVTECH is a Swedish microcap SaaS company. As the name suggests, they are operating within the aviation technology space. The company develops software solutions for airlines with the goal of making flights safer, more efficient, and more profitable. They help avoiding turbulence, choosing where to fly, and reducing fuel consumption, creating a clear win-win situation. The airlines save money, while AVTECH earns high-margin recurring revenue. At a share price of around 8.2 SEK, AVTECH trades at a market cap of roughly 460 million Swedish kronor. The company recently started paying dividends, but has been consistently cash flow positive for several years. Historically, I've been cautious with AVTECH due to customer concentration and an unclear competitive landscape. However, during 2024 and 2025, the company has taken meaningful steps forward. Growth has accelerated, profitability has improved significantly, cash conversion is strong, and importantly, this is all done while not diluting shareholders. Today, I believe AVTECH is entering the next phase of its journey. Returns could be very attractive from here, although some major risks remain. AVTECH is a pure-play SaaS company. Airlines subscribe to one or several of AVTECH's products. The majority of revenue comes from the core product AVTECH, a turbulence avoidance system. They have other products, and management highlights that they see increasing customer interest. For example, in the product ClearPath, a flight optimization product that calculates the most fuel-efficient routes, reducing fuel burn, emissions, and costs. Fuel is one of the largest cost items for airlines, and even small efficiency improvements can translate into millions of dollars in annual savings. That makes AVTECH's value proposition extremely clear. Customers are unlikely to churn. The company has had very little customer churn in the past, despite there being notable competitors in the market. Customers and competitive position. AVTECH serves a number of well-known global airlines, including LATAM Airlines, Wizz Air, and Southwest Airlines. Winning contracts with airlines of this caliber is not trivial. Safety-critical software requires long validation and sales cycles, regulatory approval, and trust built over time. This acts as a natural barrier to entry. Historically, AVTECH has had high customer concentration, which has rightly concerned investors. The risk still exists, but things have meaningfully improved with recent new customers. The previous customer concentration played a major part in why I haven't been comfortable with the company in the past. AVTECH operates in a niche market, therefore it's unlikely to attract the largest SaaS players. Still, it's large enough to ensure a long runway for AVTECH. That's exactly the kind of market I like, and one may draw comparisons to Opter and Generic. Financial performance and margins. AVTECH has delivered strong double-digit revenue growth while simultaneously expanding margins. In the latest Q3 report, the company reported an operating margin north of 40%, a dramatic improvement compared to just a few years ago. This clearly demonstrates the scalability of the business model. Over time, I foresee a potential margin of above 50%. This is due to the SaaS revenue model, very low marginal costs, and no need for heavy reinvestment. Cash conversion is strong. AVTECH generates operating cash flow close to the accounting profits, even after adjusting for capitalized development cost. While the company does capitalize some R&D, I personally treat all development cost spending as maintenance capex when valuing the business. Even on that conservative basis, AVTECH produces solid free cash flow and attractive returns on capital. An important note when forecasting for the future. They currently pay no taxes due to the poor years during COVID, as well as the unprofitable years after the IPO in 2012. The lack of taxes of course makes earnings per share and free cash flow look artificially strong, and must be adjusted for when evaluating the company. They will likely begin paying taxes when we enter into 2027, based on current earnings and the remaining deficit of 24 million SEK. Capital allocation and management. A very positive recent signal is that the CEO purchased a decent personal stake in the company in early 2025, strengthening alignment with shareholders. Coupled with strong consecutive dividend payments, as well as the non-existence of share dilution, I see strong shareholder alignment from management. This is not a growth at all costs SaaS company. AVTECH grows profitably, avoids dilution, and returns cash to shareholders. That alone puts it in a very small and attractive category of software businesses. In addition, they don't need capital to grow, meaning that the free cash flow plus growth formula applies. Valuation. So what about the valuation of the company? Looking at the sales growth, then sales hasn't declined quarter over quarter since COVID. Therefore, you may annualize last quarter's sales and multiply by 4 in order to get the annual revenue number. This is possible due to the SaaS model, but of course implies no customer churn or bankruptcies. The annual recurring revenue sits at 48.9 million. Thus, AVTECH trades below 10 times annual recurring revenue. The margin is a bit more lumpy, both for operating margin and free cash flow. Cash conversion is around 90%. Using an overly conservative free cash flow margin of 30%, the company trades at a free cash flow yield of 3.5%. The company grew 25% in 2024 and 44% in Q3 2025. Growth will decline in 2026, as the pipeline is not as strong right now, and we will likely see more modest growth moving forward. Due to the cash buildup, cash conversion, increased margins, and growth, the company will trade at a free cash flow yield of around 5% next year, with my estimations. And the company should continue to grow with new customers, more airplanes, upselling, and increased pricing. The growth in the short term, meaning 2026, is not easy to estimate. It depends largely on new customer deals or expansions with current customers. I don't want to forecast 2026 numbers due to the mentioned factors. However, I will look for growth between 15 to 20% on the top line, as well as some margin expansion. Having said this, I believe in increased OPEX for 2026, as the company is strengthening their workforce. Increased OPEX should be viewed as a good sign in my opinion, as they are preparing for future growth. The company still has a way to go with commercial efforts and onboarding new and existing customers. A stronger sales team, as well as investments in technology, is welcome. I believe there's still plenty of room for operational improvement despite the strong growth in the last few years. The increased OPEX for 2026 may lead to a stagnation in short-term margins. In addition, the company should start paying taxes in 2027 or late 2026, which will affect earnings per share growth. This should be of note to potential investors, as it could be negatively received by the market. As always, I'm interested in the long-term potential of the company. AVTECH employs only 16 people and trades at a very low market cap. They have a large addressable market and a long runway for growth. The low churn, recent customer contracts, investments in new products and employees gives me confidence in continued strong growth. Even with quite conservative growth assumptions, I deem the valuation to be attractive. Long-term sales growth should be above 10%. This is due to a couple of factors. There is a large and unpenetrated addressable market. They have potential upselling of more models, meaning net revenue retention rate should be more than 100%. The aviation industry is growing, while regulatory pressure on lower CO2 emissions will increase. All of this, coupled with price increases, ensures a strong long-term growth potential compared to their small market cap. The company has a reasonable multiple on earnings, free cash flow, and sales, as well as margin upside. I see potential shareholder CAGR above 20% for AVTECH for the coming 3 to 5 years, until growth will stall. There are some big risks, however. If one of their major customers churns and switches to a different software provider, then large amounts of revenues will be lost. AVTECH's technology is not unique, and there exist competitors with similar products. In some cases, competitor products are better. For example, AVTECH is struggling to gain traction for their paperless solutions. Innovation is necessary in these areas, and I welcome increased OPEX in order to combat these issues. In a case where a large customer churns, revenues will plummet. Luckily, the company has low fixed costs and a huge cash position. There's low capital reinvestment needs. I view the risk of dilution to be very small due to the working capital cycle. Therefore, the potential for permanent capital loss is quite small. All in all, I find a margin of safety at these levels, with huge upside potential if current growth trends continues. Keep in mind, this is a micro-cap company with both technology and customer risks. There are substantial risks when investing in smaller companies like AVTECH. However, this is a high-quality company, trading at a reasonable valuation, growing above 40% last quarter. They are riding a secular tailwind and enjoy strong unit economics. Fundamentals are improving. They enjoy strong margins, good cash conversion, and fantastic growth. The clouds that once surrounded the business are, in my view, clearing up. This is not a risk-free investment, but at today's valuation, I believe the risk-reward is asymmetric. If execution continues, AVTECH could become a high-quality compounder for the coming years. As always, this is not financial advice, just my personal opinion on a company I find increasingly interesting. Thanks for listening.